For almost 20 years, Bernie Madoff told his investors he had a strategy that barely ever lost money. Not most years, not most months, almost never. When the market crashed, his returns still went up. When the market boomed, his returns stayed calm and steady. Professional investors called it too good to be true. One of them did the math and proved it. That investor sent his findings to the SEC in the year 2000. He sent them again in 2001. He sent a 21-page memo titled, literally, "The World's Largest Hedge Fund is a Fraud," in 2005. The SEC investigated and closed the case 3 separate times. It took a global financial crisis, not the SEC, to finally bring it down in December 2008. Bernard Madoff founded Bernard L. Madoff Investment Securities in 1960, starting as a legitimate market maker trading over-the-counter stocks. He was good at it. He helped build the technology behind what became the NASDAQ exchange, and he served as its chairman in the 1990s. This was not a con man operating in the shadows. This was one of the most respected men on Wall Street. Alongside the legitimate trading business, Madoff ran a private investment advisory arm. He told clients he used something called a split-strike conversion strategy, buying a basket of blue-chip stocks, then using options to cap both the gains and the losses, a strategy designed to produce steady, moderate returns in almost any market condition. Executed honestly, that strategy can work. It cannot produce nearly 20 years of returns with only a handful of losing months, in good markets and bad, at the scale Madoff claimed. Professional investors who understood options math looked at his numbers and said the pattern simply doesn't exist in real markets. Here is the mechanism, stripped down. Madoff wasn't trading with most of the money at all. New investor money was used to pay returns to earlier investors. That's the entire structure of a Ponzi scheme. It only works as long as new money keeps coming in faster than old investors cash out. 2 things made this scheme unusually durable. First, Madoff's firm acted as its own custodian. Client money never sat at an independent bank or clearing firm where a third party could verify the trades actually happened. Advisor, broker, and custodian were all the same company, controlled by the same man, a structure that would normally be kept separate specifically to prevent this kind of fraud. Second, billions of dollars flowed in through feeder funds. Investment funds that pooled money from smaller investors and placed it with Madoff in large blocks. Firms like Fairfield Greenwich and Tremont Group collected management fees from their own clients while doing little independent verification of what Madoff was actually doing with the money. The independent verification that should have caught this did not come from regulators. It came from a financial analyst named Harry Markopoulos, who was asked by his own firm in 1999 to try to replicate Madoff's returns, and couldn't. Markopoulos submitted his concerns to the SEC in 2000 and again in 2001. Neither submission triggered a serious investigation. In November 2005, he went further, submitting a 21-page memo laying out 30 specific red flags, under a title that left no ambiguity. The world's largest hedge fund is a fraud. The SEC's own internal review of the case later found that investigators treated the evidence as circumstantial and relied on Madoff voluntarily producing documents rather than issuing subpoenas. That investigation, too, closed in 2007. No charges were filed. No penalty was imposed. What finally broke the scheme wasn't a regulator. It was the 2008 financial crisis. As markets crashed, panicked investors tried to pull roughly $7 billion out of Madoff's firm, far more than the new money coming in could cover. On December 10, 2008, Madoff told his 2 sons who worked at the firm that the investment business was, in his own words, one big lie. That it was, in his words, basically a giant Ponzi scheme. His sons contacted an attorney that same night. The attorney contacted the SEC. The SEC contacted the FBI. FBI agents visited Madoff at his home the next morning. He told them there was, in his words, no innocent explanation. He was arrested on December 11, 2008. The SEC's civil complaint that day alleged a fraud of at least $50 billion, a figure that would later be refined. Roughly $17.5 billion in actual investor principal, inflated on paper to nearly $65 billion in fabricated account statements. And the audit that was supposed to catch all of this? It came from a two-person accounting firm in suburban New York, with exactly one active accountant. David Freeling, a longtime family friend of Madoff's, who was also personally invested in the fund he was supposedly auditing independently. Freeling later admitted he didn't perform real audits at all. He signed blank SEC filings and let Madoff's staff fill them in afterward. On March 12, 2009, Madoff pleaded guilty to 11 federal felony counts: securities fraud, investment advisor fraud, mail and wire fraud, money laundering, perjury, false filings with the SEC, and theft from an employee benefit plan. There was no plea deal. He simply pleaded guilty to everything and was taken into custody on the spot. On June 29, 2009, Judge Denny Chin sentenced Madoff to the maximum, 150 years in federal prison. 9 victims spoke at the hearing. The court had received 400 letters describing the damage. One victim, Jesse Cohen, told the court directly, "Madoff is a thief and a monster." Explaining the sentence, Judge Chin said, "The breach of trust was massive." He added that the punishment needed to send a message to anyone who might try something like it again. David Freeling, the auditor, pleaded guilty separately in November 2009 to 9 criminal counts, admitting he had rubber-stamped Madoff's filings for years without performing real audit work. He forfeited more than $3 million and cooperated with prosecutors, ultimately receiving a sentence of home detention rather than prison time, a striking contrast to the man whose fraud he enabled. Bernie Madoff died in federal prison in Butner, North Carolina, in April 2021 at age 82. He served just over 12 years of his 150-year sentence. As of his death, court-appointed trustees had recovered more than $14 billion of the roughly $17.5 billion in actual investor losses, one of the largest recoveries in the history of financial fraud litigation, though still short of making every victim whole. Strip away the size of the number, and Madoff's scheme comes down to 2 structural failures that any serious oversight framework is specifically designed to prevent. There was no independent custodian. The same firm that advised clients also held their money and reported on its own performance, with no outside party able to verify a single trade. And there was no independent audit, just one accountant, personally invested in the fund, signing forms he never actually checked. And when someone did the math correctly and said so in writing, with 30 documented red flags, 5 separate times over 8 years, the system built to act on that warning didn't.